I've been following energy markets for years, and I can tell you that what's happening with Saudi Arabia right now is being completely misunderstood by most people. Social media is exploding with claims about the end of the petrodollar, but the reality is far more complex and, honestly, more interesting than the headlines suggest. Let me start with what I've discovered through my research. There never was a formal petrodollar agreement that expired in June 2024. I've seen dozens of posts claiming Saudi Arabia ended a 50-year deal with the U.S., but when I dug into the actual documents, what I found was the U.S.-Saudi Arabian Joint Commission on Economic Cooperation from 1974. This wasn't an oil for dollars mandate. It was an economic cooperation framework that actually dissolved decades ago. But here's what's really happening and why I think everyone should pay attention. Saudi Arabia is still pricing all its oil in US dollars today, every single barrel. However, the kingdom has begun accepting payments in other currencies, particularly from China, which now buys over 20% of Saudi oil exports. I've been tracking this shift since President Xi Jinping's visit to Riyadh in December 2022. During that visit, Xi told Gulf leaders that China wanted to shift oil purchases to yuan. At the time, I thought it was mostly political theater. I was wrong. The conversations have intensified dramatically. What changed my perspective was seeing the practical moves. Saudi Arabia joined China's mBridge digital currency platform in June 2024. This allows cross-border payments using central bank digital currencies, potentially bypassing the SWIFT system entirely. When I analyzed the data, I realized this wasn't just about currency, it's about infrastructure. China has become Saudi Arabia's largest trading partner. The numbers tell the story I missed initially. Saudi Arabia runs a $20 to $40 billion annual trade surplus with China, compared to just $5 to $10 billion in 2015 to 2016. When you're selling that much to one customer, you start thinking about their preferences differently. I've spoken with analysts who point out the practical challenges. If Saudi Arabia accepted yuan for all Chinese oil purchases, within 5 years, yuan could comprise 20 to 25% of the kingdom's foreign exchange reserves. That's a massive shift from current holdings, where they maintain $144 billion in U.S. Treasury bonds as of 2024. Here's what I find most significant about Saudi Arabia's approach. They're not making dramatic announcements or sudden moves. Crown Prince Mohammed bin Salman is playing this strategically, keeping options open while maintaining stability. The Saudi riyal remains pegged to the dollar, and U.S. Treasury holdings actually increased by $26.8 billion in 2024. But I can see the diversification strategy unfolding. Vision 2030 requires Chinese technology, construction services, and renewable energy projects worth billions. Accepting yuan creates a natural cycle. Earn yuan from oil sales, spend yuan on Chinese infrastructure and technology. It's economically logical. What concerns me is how this fits into broader geopolitical tensions. Russia and Iran have already shifted to yuan-based oil trade due to U.S. sanctions. Venezuela follows the same pattern. I'm watching whether Saudi Arabia's moves represent voluntary economic optimization or preparation for potential future sanctions scenarios. The technical infrastructure is developing rapidly. China launched yuan-denominated oil futures in 2018 on the Shanghai International Energy Exchange. Trading volumes have grown steadily, though they're still small compared to Brent and WTI benchmarks. But I've learned not to underestimate gradual market shifts. I've analyzed what this means for global currency dynamics. The dollar still dominates with 84% of SWIFT trade finance settlements, compared to yuan's 5.3%. But that 5.3% represents massive growth from near zero just a decade ago. Momentum matters in currency markets. What I find fascinating is how Saudi Arabia is managing domestic implications. Their currency peg has provided macroeconomic stability for decades. policymakers seem reluctant to jeopardize that stability for currency diversification gains. It's a careful balancing act I'm watching closely. The regional context matters too. UAE joined M-Bridge alongside Saudi Arabia. Other Gulf states are having similar conversations with China. This isn't just Saudi Arabia making unilateral moves. It's coordinated regional adaptation to changing trade patterns. I expect this transition to take decades, not months. Dollar displacement in oil markets faces enormous structural challenges. But the direction seems clear, toward a more multipolar currency system where yuan plays a larger role, especially in Asian energy trade. For energy consumers, the immediate impact remains limited. Oil prices are still set in global markets regardless of payment currency. But long-term implications for U.S. monetary policy and dollar strength could be significant if this trend accelerates. My assessment is that we're witnessing the early stages of a fundamental shift in how global energy trade operates. Not the dramatic collapse of the petrodollar system that social media suggests, but a gradual evolution toward currency diversification that reflects changing economic realities. The next few years will reveal whether Saudi Arabia's careful exploration of alternatives represents tactical flexibility or strategic repositioning. Either way, it's a story worth following closely.